but our next guest says are still good buys. Here to tell us why is Mark Manahay. He is the Managing Director at Citigroup Global Markets. Mark, so glad you're joining us. Give us the first pick first, if you don't mind.
Sure. We'll go with Google first. Google shares have corrected about 15% year to date. Now, that's after pretty heady growth as a stock. In 2009, the shares are up about 100%. So we've had some consolidation of those gains, but there have been some new issues that have come out on Google stock. Some of them are very legitimate. Some of them have been overstated. The valuation setup here is you can actually buy Google at pretty close to a market multiple, 16 times earnings roughly, if you strip out all the cash. So you have a secular growth story, market share leader, and you can buy close to a market multiple. That's what makes this opportunity very attractive to us.
Mark, if you had to pick one negative factor that for Google you think has been overstated, what is it?
Probably, well, this stock is traded off a lot on three factors. China, the concerns over the relationship with Apple, and concerns over the impact of this Nexus 1 smartphone on Google's margins. I think China's probably the one that's most overstated. Just to put it in context, China all in terms of the P&L is only about 1% of Google's earnings, and it does look like Google is committed to... It is. It does, and it's going to be bigger. Obviously, 1% will be 5% at some point, 5 to 10 years down the road. So long term, this is material. But I think Google is going to figure out a way to stay in the China market. I just don't think they're going to walk away from a market that's that important, that's that symbolic.
So now, you said the secondary and tertiary concerns, Apple and then the Nexus 1. And both of those, you feel like the market is unfairly punishing Google stock?
You know, I mean, all of these three are negative catalysts. The question is, do they deserve to take Google down to a market multiple? We think it's a premium growth leader, therefore it deserves a premium to the market in terms of valuation. So with the Apple issue, you know, with Apple and Google, those relationships go a long way back. They'll be cooperating on some things, and they'll be competing with each other on other things. But they're very different businesses, very different business models. At the end of the day, Google remains an advertising company more than anything else. That's not where Apple's going to go, at least not materially.
Mark, before we leave Google, what's the right price for that stock?
Well, we think with a name like this, you could see something like a 20 times multiple. If you put a 20 times multiple on 2011 earnings, you'll get to about $640. That's what we think fair value is for Google shares.
All right. Now, you mentioned internet advertising. We have to talk about Amazon.com. This is another stock that you think has been unfairly punished so far this year. But the major concern still exists, right? I mean, ad spending isn't increasing, is it?
Well, ad spending is starting to recover. Now, you know, Amazon is much more of an online retail play than anything else. And, you know, 99% of Amazon's revenue really is retail. They're growing their units, just the number of raw items that they sell, something like 37% year over year. There's no other retailer that at this size that's growing anywhere like that. But some of the issues recently, just like with Google, some of the issues with Amazon have been at the top of the list. What impact does Apple's iPad and then some of this recent publisher pricing dispute, what does that have on Amazon's business long term, particularly that Kindle product?
The iPad, the Kindle killer. Do you think that's a fair comment?
Right. I don't think so. You know, this is a very hard one to know. We're thinking 3 to 5 years out, so everybody's guess is as good as anybody else's. But put a couple of things in context. First, I think there's a market for just a dedicated e-reader. That's what the Kindle is. It's not an iPad competitor. It's a dedicated e-reader. If the price point's low enough and if the functionality is good enough, you have the iPad out there starting at $499. The Kindle right now is at $259. It's been coming down in price pretty significantly over time. My guess is, and we assume, that Amazon will bring that Kindle price down to $200 and increase the functionality of it. As a standalone e-reader for $200, I think the Kindle has a very strong growth profile ahead of it.
Yeah, we have a lot of senior editors that will remain unnamed who are Kindle fans. But Mark, what's the right price for Amazon.com right now?
So we look at this a little bit differently. It's always traded at a very high earnings multiple. That's because it has a very high conversion of earnings into free cash flow. So if you look at it on free cash flow and you put a 20 multiple on that free cash flow, you get with Amazon a price target that's more in the $160 to $170 range. That's what we think fair value is.
We thank you very much.